Hello, hello, Intel is next. I have made videos about Amazon, Apple, and now Intel is the next one. And probably I'm going to follow up with Pinterest, which is another one, if not more, because there are a lot of earnings today. Lots of work for me, but very, very interesting to see what's going on. So Intel announces up to 10 billion in cost reductions through 2025, and people really, really like that, obviously, and understandably right now. And the stock is actually up almost 5% in the after hours market, sitting at about 27.50 right now in the after hours. So let's take a look at what happened with Intel and why we're looking at some positivity here. Now, the chip maker said in the quarter that it would make chips for MediaTek as well, worth noting. Now, shares moved actually as much as 7% at some point, and they did. Here's what they did: 59 cents per share, that's adjusted, versus 32 cents per share, as expected by analysts. This is a pretty significant beat, as you can understand. That's a pretty significant one. It's almost twice as much as expected. And as we said in previous videos, when expectations are low, you may as well crush them. And this is what's happening here with Intel. And revenue, 15.34 billion versus 15.25. So again, expectations were low and they easily surpassed those. Now, overall, revenue declined 15% year over year in the quarter. So there's still a decline in, again, when you judge through the previous year results. And imagine that, the analysts were expecting even less than that. So the company did better than expected, it looks like. Still a decline, though. And the revenue also declined 22%. And again, this is what happens when you're having low expectations after you have been sinking for a while. And a lot of these companies that have been sinking for a while, like Amazon, which did like minus 20% today in terms of the stock price, or Meta, which has been completely annihilated, will have lesser expectations. And in the future, you're likely gonna be seeing some precipitous beatings in terms of their earnings reports, just because lesser things are expected of them. It's normal. Now, Intel is aiming for 3 billion in cost reductions in 2023, which is obviously something that investors would enjoy right now. When we are entering a market where economic uncertainty is around, people and investors actually like from companies to cut down on speculative costs. And some speculative costs, for example, can be investing in your own business. And so when things are not going well for the overall economy, investors, generally speaking, appreciate the cost reduction phase. And this is why you're looking at the stock price being higher than it was after they have announced for the cost reductions. It only makes sense, right? I mean, people are actually scared of companies spending around when there are issues with the overall market. It makes a ton of sense. Now, the CEO, Pat Gelsinger, warned the employees that the company would be instituting cost-cutting measures. So again, that's something that's going around the company, it looks like, for a while here. Now, the chips generated, that's the CCG, the Client Computing Group that includes PC chips, generated 8.12 billion in revenue, down 17%, but above the consensus. Again, it is still down, but pretty significantly above the consensus that was expected to much lower of them. And Intel's data center and AI segment posted at 4.21 billion in revenue, still down 27%. And this is still lower than the consensus. So yeah, there are things that the company is not doing very well with, though, understandably. And we do know that their revenue, their net income, things have been sinking for them for a while. So their previous quarter, their previous results were terrible, frankly. And they had a significant decline of something around 20-25% or something of that sort, if I remember correctly. And so the market expects much less of them, and so they could deliver much more in the future, is the thing. But it's worth remembering that they have been suffering lately. They haven't been doing that well, especially compared to some of their competitors. But remember that this company is Intel. It's a huge blue chip company that is still actually making tons of money. So don't take that lightly. Just because they were down for a couple of quarters or so amidst the current climate doesn't mean that they are a bad company or that they're going to be doing badly in the upcoming years. Not at all. Nowhere near that. Now, shares have fallen nearly 49% so far in 2022, which is insane. Absolutely insane. But it's worth noting that they have bumped up the forecast for the full fiscal year. Very notable here. Now they see 1.95 in adjusted earnings per share and 63 billion to 64 billion in revenue, compared with the 230 in adjusted earnings per share and 65 billion to 68 billion in revenue 3 months ago. That implies a decline in revenue of almost 20%, but it looks like it's better than what they initially expected. Well, that's nice to see. They had expected 2.15 in adjusted earnings per share and 65.26 billion in revenue here. So that's a little bit better, as you'll see here. Okay, so let's take a look at our tool here and decide what is going on with this company, or whether it is a buy right now. Let's just take a look. So Intel here, as you'll see, and I'm going to refresh the page just to have the very new after hours quote. Yeah, it's about the same, 27.39. Again, this changes and will be changing in the upcoming couple of hours or so, because it's very fresh and things happen. And yeah, right now we're sitting at 27 bucks. Now, the company, again, if you take a look at the financial statements, you will see that they haven't been growing that much. It's a company that has been still growing, though, like from 62 to 79, but it's just not like a tremendous growth company. It's still growing nicely, though. 9 billion, 9.6 to 19. So their net income has been increasing rather nicely, however, which is nice to see. In terms of the balance sheet, you will see that the company has been having about 73 billion in terms of total liabilities and 95 in terms of total equity here, also growing very nicely through the years. Now, cash flow is going to be weird because the company has been spending a ton in capex, and this is one of the things that they said in their report, that the fact that they are going to be cutting down on these expenses. Operating expenses and also capital expenditures. I mean, all these things are probably going to be affected in a positive manner. So you're probably going to end up with more cash flow than last year, which was like half their average, or a little bit, maybe a little bit more than half. And the thing here is that you will see that the company has been spending a ton, like from 11, 15, 16, 14, and 20 over here in capital expenditures. Now, they are making about 30 billion in terms of operating cash flow, so they are still making a ton, and their net income was 20 billion over here. And in terms of investing activities, pretty much purchasing investments, and a net buyer of investments pretty much every year as well. And in terms of financing, you will see that they are spending some cash from financing activities, mostly for dividends, 5 billion here, which compared to the free cash flow that they typically generate, it should be about 20%. But if you take a look at our metrics page, that will tell you here that we are looking at a 61% free cash flow payout ratio, but that's because of the capital expenditures. It's actually letting you know this number here. It's letting you know that there's something going on. But if you take a look at the actual free cash flows through the years, you will see that this is happening because the company has been spending a ton in capital expenditures. That's the core reason. But there is a very appetizing 5.5% dividend yield over here, which has been increasing because the stock price has been falling. And if you take a look at the dividends tab, you will see again 5.5%, and even this is a thing that some investors would like right now a lot. The fact that the company is paying dividends, some will hate it. There are two things behind that. There are some people who like it because they get money back. Now, this money is double taxed. We know that it's taxed on the corporate side, it's taxed on the individual side, so that's not very efficient. However, it's money. And so it's money that gets returned to your account. And when you are getting money back to your account, you are actually eliminating some of your risk. So imagine holding Intel for 10 years and getting paid 5%, 5.5%. You're already 55 to 60% almost covered just from your dividends. So you're getting back your capital pretty much. So you're getting paid for that. And so if there's a decline in between, well, okay, there was a decline, but who cares? I mean, you are still making more money than the decline. And so this gives an extra cushion, an extra safety net for investors that are willing to buy this for the dividend. Some other investors, and I tend to be towards that side, frankly, they don't really like dividends because it actually hinders development. It hinders spending on your own stuff, on the company side, in order to get better. And actually you're extracting cash to give it to shareholders. Maybe you're not buying back as many shares. Maybe you're not using it to become a better company. So it's not great to see in these situations. Now, since we're entering a market where the inflationary environment is rather weird and we're having higher inflation, it pays to get some money back. So I'm not a huge, I'm not hugely against them paying a dividend right now, but frankly, I wouldn't like them to continue doing that through many years, especially when the market turns and we're entering a bullish phase again. I would like them to abolish the dividend. Now, this is problematic because when you abolish dividend, you get a lot of people exiting your stock, and so now you can have a decline. So what I want to say about this one is, if you are interested in buying this company, remember that this is not going to be, more than likely, this is not going to be an explosive growth company because it is a dividends company. However, since it has been going down a lot, there is some cushion. There is some element of potentially increasing your stock price to at least where it was like a year ago. So they could still increase the stock price at like 100%, maybe in a couple of years or 3 years or so. But you may not see like a 300%, 400%, or 500% at least in the upcoming, who knows, like 5, 7 years, 10 years, or something of that sort. So it may be lower in terms of how they grow. And you can kind of see it through the 5-year chart, where the stock price has been at about a similar level. It hasn't been too high or too low, pretty much, apart from this current market where everything is selling off. Now, if we take a look at our stock evaluation tool, which matters a ton, of course, we will see that the revenue growth of the company has been slacking, and we are seeing a decline pretty much in the revenue growth of the company. So I'm gonna go with declining revenues here. I'm gonna go minus 15%, minus 10%, and minus 5%. Now this minus 15% is a ton. Remember that it's a minus 50% every year. This is what the tool is gonna be doing for these projections. So we're looking at an insane revenue growth here, or I should say the revenue decline. I just want to see it for them, for just to see what the company is going to be doing if things go really south and all of a sudden they start losing money here and there, and they don't grow anymore, and they not just grow, they actually lose a ton of their market share. I just want to see it for the sake of the argument, just to see what the company is doing in this situation. And in terms of net income margins, about 25%. So I'm going to go a little bit less, 20, actually let's go 23, 24, and 25. And free cash flow margins, 80, 90, and 100 is the one that they are doing about. And this is what I'm going to use. Now, obviously, we're going to get some low values for this because I'm going with insane revenue growth numbers. Again, it's for the sake of the argument here, just to see what the company is potentially going to be doing. But minus 50% a year is not going to happen. I just want to see it here. So let's hit calculate. So imagine that for a while. The company is actually declining minus 15% a year for the next 5 years. Imagine that for a while, right? Like minus 15% every year for the next 5 years, doing lesser margins, like 23% than what they're doing right now, and 80% free cash flow margin, which the average is about 80, so that's fair. So if that happens, then the company is worth $23 today. And the current price is going to be maybe 28 or something of that sort, because we're up right now. So imagine that. For the medium one, which the company loses 10% every year, this is like 50%. It's actually a little bit, I think it's a little bit less than 15%, 50%, because it happens through 5 years consecutively. But still, the medium estimate here is $35, even if it loses 10%. And if it loses 5% every year, like about 25%, the high estimate here would be $50 for the stock price to buy now. So you can understand that this one is extremely cheap. And this is why it's one of the core companies that I would want to be adding to my portfolio. I don't own it yet, but it's definitely my top 3. Definitely one of the top 3 companies that I want to be adding to my portfolio, my personal one, that is. And yeah, that's what I wanted to say about Intel. There's definitely risk, don't get me wrong, but it does look like it's, it's limited here for the company. There's probably limited downside. But again, every stock can go down a lot. It doesn't really matter what they are doing sometimes in terms of their financials. And you can see here, we have talked about this company for a long while. Their metrics here are pretty much almost stellar, as you'll see. Super low price to earnings, price to free cash flow. It's even lower, frankly, practically speaking. Again, because they're spending a ton is why this is at 11. Otherwise, it could be like 5 again. And so this one is a company that I really like, and I'm at some point most definitely going to be adding to my portfolio. There's no doubt about it. It's definitely one of the top ones that I'm going to be adding soon. But thank you for watching. I hope you enjoyed. Do tell me what you think about this company. Remember to leave a comment below, and I'll see you in the next video, probably making one about Pinterest. Lots of work again today. I'll see you soon. Bye bye.